Hey guys, AKIL'S here. Welcome back to the Trading Coach Podcast. Today, we're going to talk about hedging in the Forex market. What does it mean? Should you be doing it? And some warnings of what you need to be aware of before doing it. Now, before we hop in, two things for you. One, this is a video episode, so head over to Spotify or YouTube or wherever you watch video versions of the Trading Coach Podcast at. I like to make them a little bit fun with all types of funny inserts and whatnot. Two, I've been teasing you guys about a workshop that's coming up next week. I finally have a link for you. I'll put that in the description box below and I'll share more in detail about what that is, how many spots are available at the very end of the podcast. So make sure you hang around so you don't miss that. It is very important information. So, hedging. This was a question that came from you guys, the listeners, and I love it when you guys ask questions and I get to do podcast episodes about it. Sometimes I feel kind of selfish talking about the things that I want to talk about. So when you guys make requests, I know that you are listening. I know that you are excited about it. So what is hedging? Well, essentially, hedging is a strategy, method, tactic, however you want to define it, that is mainly used to protect yourself. So yeah, we can talk about it as a trading strategy, and you're going to see that a lot more in stuff like options, whether it's regular options or Forex options. But when it comes to kind of, regular trading, it's more of a risk management type of strategy versus a strategy that should be used to kind of make profits like a normal trading strategy. And essentially, hedging is this. Hedging is a way of protecting yourself, kind of controlling your potential losses. And pretty much what that means is that you're in a position going one way. Maybe there are some fears, concerns, and we'll dig into a little bit of that later about the future of that position. So you enter an opposite position in the other direction just in case the opposite reaction occurs. That way you kind of have both sides covered, and whichever way the market decides to go, the opposite position will essentially make up for the original position. So let's talk about two types of hedging. The first is going to be called single pair hedging. I don't know if these are actual terms or not. I'm making them up. This is what I call them. But single pair hedging is going to be number one. And what a single pair hedge means is that you are opening up two positions on an individual pair. So let's say, for example, we are trading the euro dollar and you are long the euro dollar, whether short term or long term, but for whatever reason, right, you're concerned about the future. Let's say there is an interest rate statement that's coming up or a monetary policy release that's coming up, and you're not sure if they're gonna hold steady, you're not sure if they're gonna cut, you're not sure if they're gonna hike, and that we know as traders that directly influences your euro dollar position. So something that you may do is, what I say we got long, right? Something you may do is you may establish a short euro dollar position just in case to provide you with a little bit of that protection. That way, if price action does result negatively due to the monetary policy statement and kind of crashes against you, yes, you're going to lose a little bit in your original long position, but your short position is actually going to make some money, which is going to help make up for some of those losses or conserve some of those losses from that original long position. So that is an example of single pair hedging. Now, here's the thing. Single pair hedging, right? At least here in the US, I think you can do it overseas and in the UK. I'm not sure about other countries around the world. You have to speak to your broker and whatnot. But we cannot technically do it here in the US, meaning that I can't have a long and short position on at the same time on the same pair. Now, one way around that, right, and we talk about this with having multiple trading strategies, is if you happen to have multiple accounts, right, maybe you're running a trend continuation strategy off one account, a counter trend trading strategy off another account, or you just split your capital up for as a risk management tactic, and whatever way you do it, right? If you happen to have multiple accounts, then you technically can do it that way, where if account A has a long euro dollar and account B has a short euro dollar, again, it's not technically on the same account, but you're achieving the same thing. So although it is illegal here in the US, or not doable, I should say, here in the US, there are ways that you can do it. There are ways you can get around the rules. We just can't do it on the same pair, same account. You'll cancel each other out. Now, an alternative to that is what I call correlated hedging, right? And correlated hedging is very similar, right? So same concept. You are long one pair and whatever news is coming out, you're fearful, so you want to be short the other one. That way you can use it as kind of like a risk management tactic. But instead of doing it on the same pair or using multiple accounts to do it on the same pair, what you're doing is you're looking to do it on, let's say, a correlated pair. So we'll stick with our euro dollar example, right? So let's say we are long the euro dollar, blah, blah, blah news is coming out. We're a little bit concerned. We want to put in a little bit of protection just in case we get a big reaction in the opposite direction. Well, what we need to ask ourselves is this: what pair is highly correlated with the euro dollar? And you got to be careful with this, right? Correlations in general, you have to be careful with. I'm not going to get started, I promise you, for you guys that are regular, consistent viewers of the Trading Coach podcast or anything I do on YouTube, or of course you guys at Tier 1 in the live sessions, you know that whenever someone says the word correlation, right? Oh, my head gets red, steam starts coming out, and I start to explode in a rant. I know many of you guys do it on purpose just to fire me up. You know me too well. So I'm not going to get into that. But in general, correlations change over time, but when we talk about correlations, we want to look for kind of consistent correlation. So like, just because I am long euro dollar, it doesn't mean I should be short pound dollar. Like, yes, that does mean I am pro dollar one way, negative dollar the other way, but those pairs aren't necessarily correlated. And if you look at two charts, either screen by screen or put them on top of each other, you'll see that they don't really share similar movement patterns. One that does share a similar movement pattern, for example, with the euro dollar, is going to be the dollar Swiss. Now, again, this is not all the time, but typically the dollar Swiss is the inverse of the euro dollar. So if you, again, split or stack your charts, if you put the euro dollar on top, if you put the dollar Swiss on the bottom, it pretty much looks like a flipped image of the euro dollar. So if you're someone that's going for a correlated hedge, if you are long the euro dollar, which means you are buying the euro, selling the dollar, you would also want to be long the dollar Swiss, which would mean you're buying the dollar, selling the Swiss. Now you have one pair that is short the dollar, one pair that is long the dollar. Because these pairs move in a similar fashion, if one does one thing, the other should do the other thing, and you have that same type of single pair correlation, but by using multiple pairs. Now again, a few things you want to be aware of when doing this. Correlations, again, I know I already went on a rant about this, but I just want to kind of hammer that in your head, because I know some people out there will be like, oh, it's as simple as doing this and this, right? You got to research your correlations, right? Correlations change over time. Sometimes they are steady in the way they are movement. Sometimes they get out of whack before kind of getting back into the same pattern. So it's not as simple as like, oh, I did this on the dollar Swiss and euro dollar last year, I'll just blindly do it again. You just want to make sure that they are moving in similar fashions or similar inverse fashions. That way you're not screwing yourself, for lack of a better term. The other thing you want to pay attention to, especially with longer term correlations, is the cost associated with doing it, right? We had this conversation when we spoke about like carry trading, for example, where, you know, people get attracted when they hear the word carry trade or when they understand what the carry trade is, where it's like, wait a minute, I'm just playing the difference of interest rates and I can just kind of buy this single or buy or sell this single currency pair, and then like instead of those rollover and overnight fees kind of costing me money, they'll actually make me money. Well, theoretically, yes, but right, it's a long process. The market dynamics change, and when you're holding positions for a long time, there are costs that are associated with it. So the same thing with the hedge, right? Let's say you're doing a long-term hedge, meaning that I'm looking at my positions right now. I'm a long-term trader. I'm seeing, hey, at the end of the month, right, the ECB has an interest rate decision. The FOMC has an interest rate decision. They're both kind of uncertain. Therefore, I'm uncertain about my long-term position. So I'm going to start this hedge right now because we know that the markets, right, they position themselves well before the news comes out. So I'm going to hedge myself now in anticipation of what's going to happen a month from now, right? I'm not saying that's a bad idea. As an investor, I love that. I love getting ahead of the game, right? I want to be in before, while it still whispers, before the general public knows about it. But understand, as you're holding both of those positions over that elongated period of time, right, Spreads and commissions on the entry, obviously are going to get you, but the rollover cost, right, is going to hit you over potentially a 30-day period. And you got to calculate that into your math when you're considering your hedge. So just something you need to pay attention to as well. Lastly, on the hedge conversation is you don't want to get cute. And this is a mistake I made. So this wasn't necessarily a hedge, but I was trying to be prepared for any outcome. So I wasn't really using this as like a risk management strategy. I was using this as a way to get involved, right? So when I was very younger as a trader, young and dumb, as some may say, I learned about this thing called the non-farm payroll. I don't know if you guys heard about it, but it's a big news event that comes out every first Friday here in the US and probably the most consistent mover of the markets. Now, this was back in 2010, and we're coming out of the what they call it, the Great Recession in 2010. No one had jobs, so like the jobs and the non-farm numbers were like the most important thing in the market. And the market would regularly move like 200 pips in the span of like 5 minutes each and every first Friday. And you never knew which way the market was going to go, right? Very early on, I thought it was as simple as, hey, research the number. Oh, the number says the expectation or estimate says this. Okay, I'll go long because of that. And I learned the hard way that the market does care about the number, but what moves the market is deviation from the expectation. So you can have a good number, but if the number isn't as good as what the public thought it would be, you have a negative reaction, or vice versa. Anyway, I thought it was a great idea to develop a strategy where I would just kind of not hedge, but bracket the market. So imagine like this being your candlestick at, right before the non-farms. I would put a buy stop order above. I would put a sell stop order below. And whichever way the market broke out, I would get involved, right? That's what I thought was hedging back in the day. It seems like a good idea theoretically, because it's like, okay, if the market goes up, I make money. If it goes down, I make money. Like, it's a win-win. But understand, during these high-impact news events, there is something called whipsaw. And imagine whipsaw, for you guys that are old WCW, WWF, WWE fans, is when you are being thrown off the ropes, right? When The Rock does a thing where he throws you off the ropes, it hits you with the rock bottom, boom, and then does the that stuff and goes back and forth and boom, hits you with the people's elbow. I really hope you guys know what I'm talking about. If not, I just looked like an idiot. Someone in the comment section below, please acknowledge that you know what I'm talking about. I'm not just this crazy guy. Anyway, so it's kind of like that. That's what imagine if you can visualize whipsaw. If whipsaw was a person or a thing. If that was you, like if that was your account, that's what you would be doing during the whipsaw. And in the market, what that means is it goes like it spikes up on initial reaction, then it goes down, it goes up and goes down, and goes up and goes down, and then it finally makes up its decision after the market has time to think. Think about it as like a mass panic where like something comes out. Most people don't know if it's good or it's bad, but everyone's running in different directions, and you're that person where you're running this way, then you see everyone running that way, then you run that way, and then until the market takes time to settle and actually digest the news, then we get a clear direction. And what happens when you're bracketing your account like that is like the market may pop up, right, initially, and now you're long, and you're all excited because you're up a couple pips, whatever like that, but then it goes right back down. And it goes right back down and it hits your stop order, right? Which takes you out of your trade. Well, now you're like, oh my gosh, right? I got stopped out. I lost some money. I was wrong. It's a false breakout. Instead of going up, it's going down. So what do, right? You enter your order and you get short. And you get short, right? As the market already moved past, so you're a little bit late to it. And then it gets another reaction. It goes up again. And now you're like, oh my gosh, I was trying to make money back and now I'm losing even more money. Let me get out of that trade and go long. And you keep doing that. You're just always late to the party. So you want to be very careful with that because it's cute. It sounds like a good idea, but the practical application is a lot different than kind of the theory. Now, just to answer one more question, and this isn't technically hedging related, but kind of. This goes back to the correlated pair one, right? 'Cause I get this a lot. I have a live trading room where I trade live with a bunch of traders 3 days a week, right? And you'll often see me get long and short correlated pairs, or, for example, so let's say I may have a bullish entry, I may be long on the euro dollar, but then I'll have a bearish entry short on the pound dollar. Again, long on the euro dollar means that I'm selling the dollar, right? And short on the pound dollar means that I'm buying the dollar. And the question comes in, Akil, like, why would you sell the dollar on one pair and buy the dollar on the other pair? And again, the short answer is that these pairs are individual, right? The euro could be strong against the dollar, the pound could be weak against the dollar. Like, both things can happen. The dollar doesn't necessarily have to be strong or weak against every single other currency pair out there. It's a battle between the two, right? And every economy is a little bit different. But the thing is also this, even if it moves in the same direction, right? So even if the euro dollar goes in my favor, which would mean I'm making profit, and the pound dollar goes against me, which would mean I'm losing money, right? You can still make money off of that position. And here's what you need to think about. Let's talk about risk management and specifically your stop loss. Now, if you put yourself in a positive position with your stop loss, say you are someone that uses a 2-to-1 risk reward, right? Let's just on this particular trade, for example. Think about your two trades. You're going to have one winner, you're going to have one loser. Now, a lot of people think that's a negative because you're like, oh, you're a 50% trader. That must mean break even. No. I've shown you the chart before, right? It does not mean that. I'm historically a 50% trader. I've inched myself up to about 55, right? I'm getting a little bit better in my old age, but I'm about a 55% trader, right? So I don't win that much more than I lose. The key is when I win more than what I lose when I lose. When I win more. I win more when I win than what I lose when I lose, right? My average win is bigger than my average loss. Gosh, that would have been duh. That's a much simpler way to say it, right? So if we're thinking about risk reward in a sense, let's say you have a 2-to-1 on both of these positions, right? And position size is the same, your risk is the same, you're risking 2% on each trade, right? So everything else is equal, right? When you win on the euro dollar because it's gone up, you've won this much. Because your risk on the pound dollar is smaller, when you lose, you've only lost this much, right? So even though you've won one trade and lost one trade, because you set yourself up where your average win in general, right, consistently is greater than your average loss, right? One win and one loss still equals profit for you, right? So there doesn't need to be a fear of entering, having two different positions in two different directions on the same kind of base currency pair, right? If you have your risk management set up correctly, and again, it doesn't always happen like this. I've had plenty of times where I've lost on both. I've had plenty of times where I've won on both. I've had plenty of times where one won, one loss. I've had times where one won and the other one was break even. Like it's an assortment of kind of outcomes when you do something like this. But the point is, you don't have to fear it, and that comes down to your risk management strategy. And although this isn't necessarily the same as hedging, right? Because it's not the same type of correlation. It circles back to our original kind of idea about hedging being more of a risk management strategy than just like a profit-making strategy. So I hope that made sense. If not, leave questions below and I will be sure to address them. And remember, Trading Workshop is coming up soon. We're going to kick it off on March 11th. It's a 3-day workshop, so 11th, 12th, 13th. Really important. Only 200 spots available, right? I told you we're going to put a ceiling and a cap on this because we like small, intimate groups. We just get a better experience with that instead of having like one big thing. So make sure you reserve your spot now. Again, 200 members. It starts next week on the 11th. This is a live online trading workshop. We're going to teach you everything you need to know about trading, and I'll continue to plug this until we fill up those spots. So link is in the description box below. Like, rate, subscribe, do all the things that make me happy, and I'll see you guys next time. All right, take care.